Washington made a move that rippled far beyond its shores. Two of America's biggest financial institutions, J.P. Morgan and Bank of America, were abruptly instructed to back away from a major stock sale involving a Chinese company. What made this shocking was that the entire deal was unfolding in Hong Kong, a market with its own rules, outside U.S. legal reach. Beijing didn't shout, complain, or protest. Instead, it responded with absolute stillness. No statements, no warnings, nothing at all. Yet beneath that silence, China began executing a quiet but extraordinary shift. Massive quantities of U.S. government debt started disappearing from Chinese hands with no public explanation. There were no dramatic announcements, just a steady, deliberate retreat that is still unfolding. This wasn't the usual back and forth of trade disputes or tariff battles. Something deeper was happening. The financial links that kept global markets tightly connected for decades were being loosened piece by piece. Washington believed it was applying pressure to contain a rising competitor, yet that pressure may have triggered consequences far beyond what American policymakers expected. Instead of reacting with threats, China began reorganizing the foundation of its wealth. And when the world's second-largest economy starts shifting, vast sums out of the financial structure built after World War II, the entire system begins to tremble. The change isn't explosive or loud, but it is unmistakably real. What began as a blocked stock listing in Hong Kong might eventually be seen as the moment the post-war financial framework began unraveling in slow motion. The roots of the confrontation lie in what looked like a routine corporate listing, one that would normally pass unnoticed. The company seeking to raise funds was CL, a major Chinese producer of cutting-edge lithium-battery systems used in everything from electric cars to energy storage grids, and increasingly, technologies with military relevance. The firm sits firmly inside China's push to develop homegrown strategic technology. The listing was set to raise around $5 billion, a sizable deal but ordinary for Hong Kong. Demand from Asian investors was strong. J.P. Morgan and Bank of America were preparing to support the sale as lead underwriters. Then, without warning, the U.S. National Security Council issued a classified assessment on March 27, 2025. According to the report, the company wasn't just a commercial manufacturer. Its technology fed into defense-related research networks and could power future military systems. Here's what made it unprecedented. The U.S. intervened in a transaction that had nothing to do with American soil. Hong Kong isn't under U.S. supervision, yet Washington insisted the banks withdraw immediately. Within 48 hours, both institutions exited the deal. The fallout was instant. CL's valuation dropped by hundreds of millions, investor confidence wavered, and other potential partners hesitated to step in. The United States had revealed a new kind of reach, one that extended far outside its own borders. Analysts began calling this strategy extraterritorial capital deterrence, a method of using influence over private financial institutions to achieve geopolitical goals. Wall Street was effectively told that national security would override business interests anywhere in the world. Supporters saw it as a necessary defense against strengthening a strategic rival. Critics argued that it damaged the very strengths, openness, reliability, consistency, that made the U.S. financial system the center of global capital. There was also a symbolic message. Washington no longer treated Hong Kong as neutral middle ground, but as an extension of mainland China's strategic orbit. Beijing noticed, and its reply came not through speeches, but through money. In the days after the intervention, Chinese banks and sovereign funds began reducing their U.S. Treasury holdings. It wasn't chaotic selling. It was calculated and disciplined. By the end of the first quarter of 2025, China had trimmed its exposure by nearly $80 billion, the sharpest reduction in almost a decade. Earlier that year, China held roughly $1.67 trillion in American assets. That pile is now shrinking quickly. This wasn't emotional retaliation. It was long-term repositioning. Analysts described it as diversification dressed as diplomacy. China was preparing for a world where reliance on dollar-based assets could become a strategic weakness. Where was the money going? A surge of Chinese demand for gold, rising purchases of BRICS-linked infrastructure bonds, a shift towards yuan-denominated assets, and, surprisingly, a jump in Chinese buying of Japanese government bonds, seen as stable, liquid, and outside direct American influence. China wasn't stepping away from global finance. It was stepping into a parallel system, one designed to operate with far less dependence on Washington. And the consequences for U.S. fiscal policy, global bond markets, and the entire financial order could be far more severe than anyone anticipated. For years, the U.S. counted on a simple truth. Foreign investors would reliably buy its debt. That assumption allowed the government to spend heavily without feeling the pinch of high interest costs. But when its largest overseas creditor begins trimming holdings quietly, the math changes fast. Fewer buyers at Treasury auctions push interest rates upward, which in turn makes servicing the national debt more expensive. Higher borrowing costs fuel larger deficits, creating a vicious loop. The Federal Reserve watches this unfolding, but any solution comes with a cost. Deep budget cuts, steep tax hikes, or printing money in a way that risks runaway inflation. The stakes go beyond numbers. For decades, U.S. Treasuries weren't just safe. They were the cornerstone of global finance. Their strength came from trust, faith in American institutions, the stability of the dollar, and a predictable system. Once that trust erodes, even slightly, the consequences spread quickly. China is quietly testing this new reality, not with headlines or sanctions, but through calculated moves in markets and settlement systems. Beijing isn't trying to break the dollar in one blow. That would backfire. Instead, it's quietly building the capacity to operate independently, while the world watches and some begin to follow. Washington faces a hard question. How do you respond when your influence is drained not by conflict, but by patient, deliberate disengagement? The response emerging in Congress is sweeping legislation designed to cut U.S. financial exposure to China. In April 2025, the Senate Banking Committee advanced a bill targeting more than 220 Chinese firms in critical sectors like defense, artificial intelligence, biotechnology, and telecommunications. The financial implications are massive. These firms account for roughly $812 billion in capital connected to the U.S., spread across index funds, pension plans, private equity, and American depository receipts. If enacted, U.S. investors would have only 12 months to liquidate positions. Giants like BlackRock, Vanguard, State Street, and Goldman Sachs would face forced sales of enormous portfolios, regardless of market conditions. BlackRock alone has around $115 billion in assets that would fall under the law. This is far from a silent exit. Markets will feel the impact. The consequences ripple beyond just the targeted firms. Passive funds, designed to track market indices, would face impossible choices: rebuild around political restrictions, tolerate tracking errors, or pull out of Chinese markets entirely. Analysts predict that forced selling will push prices below intrinsic value, creating opportunities for local Chinese institutions to acquire high-quality assets at discounts. Liquidity would tighten, volatility spike, and Wall Street's footprint in Asia, a market worth $34 trillion, would shrink. Meanwhile, some Chinese firms listed in New York are exploring delisting, not out of preference, but because regulatory unpredictability makes planning impossible. This scenario strikes at the heart of what made U.S. markets powerful: openness. Historically, anyone could list, anyone could invest, and capital flowed based on risk and returns, not politics. This transparency made New York the world's financial center, but it relied on a stable geopolitical backdrop and trust in market neutrality. That foundation is cracking. Markets are being pulled into geopolitical competition, and while national security concerns are real, the economic cost is rarely addressed. History shows the pattern. When politics overrides markets, capital migrates. Firms list elsewhere, investors find alternative channels, and a once dominant hub slowly loses influence. London saw this under heavy regulation. The lesson repeats worldwide. Beijing watches closely. While Washington debates and legislates, China is quietly constructing an alternative system. In early 2025, the country committed $423 billion to build domestic financial infrastructure capable of performing the same functions as Western institutions. Investments target everything from bond underwriting and cross-border payments to fintech platforms rivaling New York and London's clearinghouses. Credit ratings are a key focus. Global agencies like Moody's, Fitch, and S&P have long shaped borrowing costs worldwide. Beijing plans to replace them in domestic bond markets by 2026, with Chinese-controlled agencies under local oversight, giving China control over a critical lever of finance. The impact is already visible. The Shanghai International Board, China's Nasdaq, recorded $112 billion in foreign listings in Q1 2025. Companies from Southeast Asia, the Middle East, and Africa are turning east rather than west for capital. Previously, New York was the default choice. Now Shanghai is emerging as a major alternative. Several factors drive this shift: freedom from geopolitical risk, alignment with regional time zones, access to Asia's massive consumer base, and the perception that global financial gravity is moving east. One analyst notes that Wall Street's retreat isn't limiting China. It's accelerating domestic financial growth, and making it more appealing internationally. Attempts to isolate China may unintentionally strengthen it. Challenges remain. Capital controls are strict. The yuan is not fully convertible. Regulations are less transparent than Western standards, and trust in state-run institutions is limited outside aligned nations. Yet the trajectory is clear. As the US tries to sever ties, China is quietly building the capacity to operate independently. Step by step, infrastructure, not rhetoric, is reshaping a world where reliance on the US is no longer assumed.